Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have another Ask Me Anything with FT71. The AMAs are designed to be quick and casual. We're going to limit it to about 30 minutes. I'll post the recording after we're done. Go ahead and start typing your questions, and as we get set up and turn control over to FT71, we can start taking a look at those. How's it going, FT?
Good, good. Thanks for having me on again.
Sure. Anytime.
All right, let's switch over. I'm just going to display my main ES chart. I just want to remind everyone that trading futures, options on futures, is not suitable for all investors, and that past performance is not indicative. What questions do we have, Mike?
Let's take a look. Looks like the first one is from Rex. And he's basically saying he understands that there's a 4 or 5 point rotation in the ES, then probability of a rotation continuing without a 1.5 point pullback is relatively low. But what about if there's a 6, 7, or 8 point rotation? For example, if we get a 7 point rotation into a zone, does this give you super high confidence, or does the larger rotation make you hesitant to step in front of the move?
Okay, really good question. So, am I here? I don't know what's going on with these microphones.
You're back now, yeah.
Am I here, Mike?
Yeah, we got you.
Yeah, I don't know why my my Bluetooth headset here just keeps switching off. Knowing the rotations for the ES is very important because, or for any product. Every product has a rhythm in which it trades. There are habits to the participants within that product. It looks like we're giving up the 15-quarter in ES. I just tweeted that out. So expecting new lows now, looking for a test of 1804 next for those who trade the ES. But knowing one of the things you should know about the product that you're trading, not only daily range, how often it tests a non-pit session high or low, or the overnight session high or low, but you should know what the normal rotation for any given product is. In other words, how far does it go when it moves up and down? When it moves up and down on a regular basis. So for the ES, that number is 2.5 to 3 points per rotations. So from the high to the low, back to the high to the low, you see these zigzag numbers here. Those are generally 2.5 to 3 points generally in the ES. The probability of the market moving 6, 7, or 8 points without a 1.5 point pullback or 6-tick pullback is pretty low. It is generally in the 2 to 3% range. Okay, and if I see this market, let's say I'm stalking. By stalking means watching carefully. Like one of the trades I took earlier today was right here, the short. If I'm stalking a short against prior day's high, the open, the mid, hope you can see my chart clearly here. If I'm stalking this area right here, which I took a short in this morning, I like seeing a big rotation. This was a 6.5 point rotation. The probability of a 6.5 point rotation continuing to 7 or 8 is in the 2% range in the ES. That's 6 points without a single 6-tick pullback. That gives me confidence in the short. So in this situation, I see it push 6.5 points. This is an impulsive move. A pullback 2.25 points, and then it pushes again 3.5 points before it starts to rotate again. I'm going to take the short. I'm looking for the short here. The short. The intention for the short in this situation is for it to fail to test the open, the mid, prior day's high, and then rotate back down and take out the last low at 1820 with a target of 1675, and that's what happened with this trade. All of that you can see in real-time tweets on my Twitter stream, FuturesTrader71. And what happened is it ended up pushing down to within 2 ticks of my target at 1675 at 17.25. I always front run my targets by 2 ticks, always, even in volatile markets, but still it was hard to get a fill at that low here. But in general, when I see a big rotation like this into an area that I'm interested in, it actually gives me more confidence, because the probability that the ES will have a 6.5 point rotation, a pullback, and then another 6 or 5 or an exaggerated rotation to continue is unusual. When it does it on news, it does it on some release, economic release or something like that, but it's unusual for it to do that. So that's one of the metrics I look for. It's a good question, Rex.
Okay. Rex also wants to know if you can explain campaigning.
So campaigning is a way of managing risk. It's interesting. I wish I'd known that question was coming, because then I would have just started up a platform here and showed you. I'm going to try to do that, but our time is limited. Campaigning is essentially improving my entry by scalping around a position. That's what campaigning is. It's taking the current entry, let's say on this trade, the short at 20 from the 27.5 area. I got in at 26.75. If the market starts to wiggle around in this area, if it starts to wiggle around, I look for 2 to 3 tick scalps around that, and as I bank profits, my risk profile actually improves, because my average starts to climb away from my entry. Again, I wish I'd known about this question. I would have loved to demonstrate that for you. But essentially, if I got in at 27 and the market starts chopping around and nothing has changed to tell me that this trade that there's something wrong with this trade, what I'll do is I'll start to look for it to push through 27 by a few ticks, sell that, buy them back at 27 or 26.75, and then it pushes again, sell that, and buy them again, and so on. And every time I get 2 or 3 ticks, the average that I entered, the average price that I entered with starts to improve. It starts to get higher and higher and higher and away from the actual noise. This is an advanced trade management strategy. It is not recommended. If you have any issues taking losses or any discipline issues of any kind, you really need to stay away from doing this, because what some people do is they get in, add one, they stare at the screen, they're not responding to what the market's saying, which is to get out, and then they end up, turning a bad loser into a disaster. So it's not recommended for everybody. It's something you want to do if you have your discipline in check. But I'll take a moment to demonstrate it as soon as my platform's up on this computer. It's usually on another computer, but I'll try to show you that before we leave today.
Okay. Brandon is asking, he says that you've stated before that you're a all in, scale out, but does that also mean that you scale out of losses similar to your gains?
No, my losses, so I'm all in, scale out. I'm all in, scale out generally in almost all trades. I will scale into trades in areas of confluence. So this particular trade actually would have been a scale-in trade. There's a lot going on in this area. 28's yesterday's high. 28.50 is an old point of control from which the market fell a few days ago. So if you look at this right here, 28.50 is this point of control, and then on Friday we fell from that price, so that's an additional thing. Yesterday, 28's the high, and then today we had the mid, the opening swing high. We had the mid in this area. We had VWAP being at 29.75.30. I would have scaled if this position had gone against me. I would have scaled back into this on a larger rotation, and then I would have taken some off at my original entry. So I do scale in. I always scale out, and I scale out for the simple reason that I cannot tell what the future is going to hold. So my primary task is to secure my risk, and I secure my risk by scaling out. So the profile of a scale-out trade, I have actually on my blog an old post on the anatomy of a scale-out trade. You'll see that as soon as you scale out, your risk profile changes tremendously. It's an asymmetric risk profile when you scale out, because in an example that I just recently did for stage 5 client-only webinar, by scaling out, I give up on a one trade that I demonstrated. I gave up about 28% of the gain I would have secured had I held on to the full trade into its target. So I gave up 28%. But on my first scale, after I got in, once I got my first scale, my risk dropped 50%. It dropped 50% on that first scale. That's not to mention what it did on the second scale and then the target. So for 28%, I get to gain 50% of my risk back. And to me, that is, I'll take that trade all day, every day, and that's what I do in real life. So to me, you know, being able to scale some of the position off and then hold a runner gives me that edge. And if I get stopped, yes, I do get stopped on more size because I'm all in and I'm scaling out. So I'm giving up 28% on the target, but if I get stopped, I'm getting stopped on the maximum size possible. So this does not work for somebody who's on a trend following program that gets stopped 70% of the time and then gets paid 30% of the time on a much greater basis. My full stop out rate is not high. So if it exceeds 38%, I start to get worried. So I am not too concerned with the trades that stop me out with a full unit on. It doesn't happen all that often, or on a relative basis, it doesn't happen that often. But then as soon as the market moves in my direction, I scale something off, and it improves my theoretical average, and it allows me to just sit there and let the market play out the plan that I'd set out for that particular trade without you know, over talking it or micromanaging it.
Okay. I just want to remind everybody that you can type in your question. Usually we have so many questions that there's not enough time. And today there's only about 3 or 4 questions. All right, Tony.
That's a sign of improvement, right?
Yeah. This is the first time that's ever happened that I can remember. All right, Tony is asking, he says, as the price approaches a level, what are you looking for to determine whether to skip that level or go with the direction of price into the level, or even to fade the price direction at the level?
So I don't, one thing I don't do is say to myself, hey, I'm going to get short the mid and go and load the book, load the order book with those trades to short. What I do is I respond to the price action as it happens. So let's say, for argument's sake, let's say I'm looking to get long the 13. As the market falls into that 1813 down here, I'm not actually bidding the 1813. I have no interest in standing in front of a market. There's no way for me to predict that it's going to slow down or stop at my level. My levels are just based on research and a plan, but the market has to come to me in order for me to trade. Whereas most people who are having a hard time that I've worked with, and even the prop guys that I've backed, they tend to be proactive and to go after the market to trade. So they wanted to get long the 13. If they miss the trade, they're looking for any pullback up here to buy, or they're just going the market so they don't miss the run up back up to 2175 or whatever. I don't do that. I wait for the market to come to the level, show me what it's doing. Am I seeing participation from the other side at that level? If I am, then I'm going to give up 1 or 2 ticks to be able to get in and in a position so that I have that first scale out, which is key to my methodology. I have to get that first scale out to be able to hold for the bigger move. So when I determine that I'm going to get long, let's say on this drop, I've got, you know, even in the morning trader bite, I don't know if you've watched those, and when I say I'm looking for some support at this level, I'm going to trade that level. I cannot choose to pass on a certain level. I can't pick and choose trades that I want to take or not want to take. I don't do that. If I say I'm going to be looking to get long around 1813, I'm going to get long around 1813 because I can't tell which ones work and which ones don't. However, a combination of what the dome is saying, how the chart is reacting on this trigger chart. This is my trigger chart. It's a 2-tick Renko candlestick. Based on how it reacts, I need to see that there's some support there. Then I go and lift the market and go with it. So I don't pass on levels where I believe that a trade should be executed, because then I'm just basically wasting my time. I'm just doing all this homework and stuff so that I can, I can then pick and choose the trades that that I take or don't take. It's like a system. You have to take your signals.
Okay, this is a pretty similar question, so you let me know, FT. Jeff says it's been his understanding for the past 2 years that you faded levels, and when you got to the price that you relied on or that your dome was reading, you would decide whether or not to take the trade, or if you would scale out as folks wait for confirmation that are just getting in. Could you clarify as to whether or not this is how you trade? So this kind of just answered that, but you let me know.
Yeah, I see what Jeff is looking for here. No matter what you're doing, I'm not a breakout trader, but if you're not a breakout trader, which means that you basically wait for something to happen before you go to the market and watch it break, that's not how I enter. I fade. And it doesn't mean I'm fading the sell-off. It means that even if I want to get short, I'm going to fade a move up to get short. I do not want to place my trade at a point that is so far away from where I would be wrong on the trade that it's now I have to trade a one lot to be able to make up for the risk. So even though the trend is down right now, I'm not going to just sell new lows into yesterday's low. I still expect this to test 1804 today. This is what's expected. We have a weak low. So I'm looking for a short. I am not going to just get short. I am fading. I'm going to fade a pullback to an area to get short. 1675 is that area actually, but I'm on this, so I'm going to pass on this trade. But so I'm always fading. I'm always fading something. It doesn't mean that I'm trading the classic market profile, find value, fade value. Even in a trend day, I will fade a pullback. But I still don't put my orders out there for the market to pick off. I'm proactive about my entry, and I'm proactive about my scale outs. My entries do combine some dome reading. I want to see what velocity there is at the areas that I want to trade. So I'm going to pull up the demo here because I'm on my charting. So I'm watching things like velocity. So I want to get short. Here, let's put this. This is what I manage trades with, the trade analyzer. So I want to get short. I'm looking for a short here. There's nothing for me to do here. I'm looking for the market to give me some idea about where to get short. So there's nothing for me to do here, but I'm going to look to fade against some support or something to be able to get that short on. We don't need this chart, so I'm just going to kill it, and then we can squeeze this over so I can see more of the screen. And as the market makes its decision to push one way or another, I'm looking for a reaction. So we can do a bunch of dome reading here, but we don't have time for that. There's 10 minutes left. But I'm looking for which way is this more aggressive. If you're not good at reading this, there's a tool out there that I really like. It's called Jigsaw. Jigsaw tools. I actually have them on this platform. That show you what changes in a dome, and Peter does a good job of explaining how he uses it to trade. So I'd recommend that as a tool that helps support your trade decisions. But no tool is going to help you if you're just randomly trading the market just based on how it prints. You need to make a decision first as to what the market's trying to do, how good of a job are the buyers or the sellers doing, and then decide decide, okay, my bias is to get short. I'm looking for new lows. I'm looking for this 12th quarter to go, and then now your job is very narrow as a trader. Your job is narrowed down to finding an entry that causes the market to more easily give you a scale out than a stop out. So if I'm finding an entry, if short, I'm not going to wait for it to come back to 1650 and push through to get short. I'm looking for failure out of this balance here. So it's probably not going to do that in the time period allotted because we probably have more questions. But I do watch how it prints. A 3 lot up, 2 more, 3 more, 30, 25 more, 1 lot prints down, 67 print up. There are buyers still active in this area. It's not giving up yet. That's the sort of thing I'm looking for. On the dome, I'm looking for what is on the bid or offer. This is the offer. This is the bid. How much is trading on the bid or offer, and what is the velocity of it? Well, how quickly are those prints coming, and how aggressively? Is it absorbing, or is it just is it somebody constantly taking away? So here it's starting to break. I would look for the short here to sell. I missed it. Doing too many things at once. But it's starting to show you it's got failure. So this is where I would start to bang away at it, just like I tried at I think 1475 or 1450, and then I start to manage everything with the trade analyzer, and this is where I would campaign. So here's a simple campaign strategy. Let's let that get filled. So I'm filled. Change that to 1 lots, and see how it treats that 4 lot right now, and then I'll start to manage the trade based on how the market's treating this. So I'm expecting the market to pull back up to 15 here in the short term. And as it pulls back to the 15, I'll sell the 15, I'll sell 1475, and I'll take back 14. Back and forth until it decides to break. Looks like it's breaking. Anyway, sorry, Mike. I know you didn't intend these AMAs to be a lesson in dome reading, but this is a topic that I get so many questions on via email and so on, and I thought this would be convenient to address. I can take other questions.
Sure, yeah, no problem. And I just want to quickly mention that for anybody that likes the jigsaw stuff, if you're a BMT Elite member, there's a coupon code there. All right, Jeff is asking, he says he's seen recently some poor highs and poor lows today as an example. At which point in today's example do you determine that sellers are in control?
That's a big question because it's all based on context. So there's a poor high up here. But the market found sellers that put in a poor high, but it could not hold those prices, and it starts to push through the mid and back into the prior day's range. It's the sell side. So now you're attacking poor lows more than you're attacking poor highs. That's what the context is that is governing the trade. It's that simple. Okay. See how I took the 1 lot off, I think maybe at 13.25. See now my average is 18.1483 instead of 18.1450. So if I and I have 3 on left, if I wanted to scratch this trade, my scratch price is now 14.75. Campaigning means adding one, taking one off. Here, I'll add another one. So as soon as I take this off, as soon as I get filled here at 13.25, this price will improve. See how it dropped back to 14.56? My average on the screen is 14.25. That is not a true average, and it's not because the S5 trading platform is wrong. This is how all platforms work. See now I got filled at 13.25 for my scale out, how my average improved to 18.15. So now on the 3 lot, my scratch price is actually 18.15. See how it improved from 14.15 to 18.15, 14.50 to 15 even, and it'll continue to do that. That's what campaigning is. That's too tight. It's probably going to take the low out. So here it is, the theoretical average again changing to take into account the profits that I've already banked on this trade. And that's what campaigning is. It's basically trading around the position so that I can improve my price over this area. We have a double bottom at 12.25. It is unlikely that this bottom will hold. So I'm working this 12 even, as it'll probably one ticket at least. Again, this is not suitable for all traders. This is an advanced way to manage trades. You want to hit me with the next question?
Yeah, real quick. Does your theoretical average include commissions or no?
No, it doesn't. This whole platform is based on ticks. We don't want to talk about dollars when we look at trading, because we're measuring performance by ticks, and when you measure performance by ticks, it's agnostic to all. It's agnostic to the product that you're trading, and commissions are not included in this. And the historical trade analyzer will have commissions included. See, this one ticked, so now we're in danger here. So this is in danger because it only one ticked that low. Not liking this anymore.
Rex wants to know what's the tightest stop that you normally use on the ES?
Tightest, probably 3-4 ticks generally, 6 to 10 ticks generally.
Keith is saying that you mentioned a 6-point rotation. Should we get that off the bottom today? Or if we got that off the bottom today, would you short it? You mentioned you're looking for 1,800.
I'm sorry, say that again. I didn't get that question.
Yeah, Keith says you mentioned a 6-point rotation, and if we got that off the bottom today, would you short it? You mentioned you're looking for 1,800, he says.
No, I wouldn't just short a 6-point rotation up just for the heck of it. The 6-point rotation pushed us into that key area, the 2850 area, and that's why I'm interested. So I'm not looking to buy or sell any rotation that is 6 points plus. That is not a trading plan. You're just basically trading randomly. So for me, first I have to determine what direction am I going, what area am I interested in, and then allow the market to show me its hand. Who's in control. And then I look for those bigger rotations to hit the market. It doesn't necessarily have to, I don't necessarily always have to trade on a big rotation. I'm simply looking for a big rotation to add to my confidence in that trade. And if it doesn't work, generally the market takes me out right away, which I prefer. If my stop gets hit, I don't want to sit there and get one ticked and one ticked. And I want it to just blow right through and take my stop out fast. So generally, when you have a big rotation into a level, the market has a harder time pushing in through that level and stopping you out right away. But if it does, it just means that I'm really, really wrong, which I'm okay with as well.
Right. Let me combine a couple of questions here. Ron wants to know what chart you're looking at to determine if you're correct with your entry, and Tiger is saying, what kind of chart are you using? What is a 2-tick Renko chart?
Okay, so I'm looking at a 15-minute with volume profiles to figure out what my overall lay of the land is. So this is showing me 3 days of regular trading hour trading, each one showing me the volume profile for the day, and based on that I'm measuring how the auction is going. In addition to that, I'm looking at a composite. This is the volume at every price going back to October 9, 2013, and I'm basically seeing where traders traded a lot. Like see this area with the 3 prongs here, 3 volume prongs? This is a high volume area, and this is where we stopped as we sold off on Thursday on that big sell-off day. This is where we stopped, right down here. 24 is the last prong in this high volume area, and the low is 23.75. And what we've done is basically struggled with this area so far. We're trying to maintain this because participants like these prices in the past. The market has memory. So that gives me a big picture thing. So all day long I'm watching this 15-minute, but when I'm looking at doing those trader bites or the homework, I'm looking at the big picture. I'm always starting with, okay, what has the market done? Who's in control here? Lately, we've been in balance since March 4th, and then we broke out of that balance to the downside. So if we broke out of that balance to the downside and we moved away from the 64.50, this move started from 66.50, then the next logical place for the market to test, now that it's told us, hey, I can't hold these prices, we're going lower. Once it breaks, I expect this 1800, and that's why I mentioned it earlier. So I expect this to be the area to be tested next, and it could sit here for a couple days trying to make higher lows and higher highs back into that balance zone. But the expectation is this auction is not complete until it pushes down to 1800 to find the buyers that were left behind there. So that's the big picture, and that's basically what I'm looking at to form my bias for the day. But the immediate bias for the next trade is off of a 15-minute, and it combines a whole bunch of stats that I've done, even on a prior Big Mike webinar, in a combination of with how is today trading. Today pushed out of the prior 2 days range. So this is Friday, this is Monday. We've pushed out of the prior day's range. We were looking for 34.50 this morning. It pushed to 37.25, and it came right back and has traded back into the prior day's value. So short is it. I'm going to be looking for shorts until this market pushes right back over 25 and 28. I'm going to be looking short. So I'm going to be fading anything that moves up, just like you saw in that demo.
Okay.
So that's what forms my ideas.
Bart is asking, what do you think about automated trading systems that are offered by other brokerages as they advertise them as a pretty good result?
Bart, so it's tough for me to answer that question because I'm a partner in a brokerage. We do offer some trading systems, but I always approach trading systems with skepticism. I've been involved with creating automated systems and also been involved with some pretty poor results, live results, even though the demo or hypotheticals looked amazing. And that's been my experience. However, with the newer stuff that we're working on now, I do a lot more vetting. I'm able to see the code. I'm able to see what it does. Are there stops? When do the stops trigger and things like that? I'm going to tell you that unless you trust the broker recommending it, meaning the broker, not the brokerage, the broker, the person, you need to do a lot of due diligence, and unfortunately, because you are a consumer, you're not able to see what the program does. In my opinion, it is hard to invest in anything, be it a trading system or a hedge fund or whatever, and then base the results on the first few trades. When you make that investment, essentially this is risk capital. This is money that you're willing to lose without affecting your lifestyle, and you need to kind of review it on a quarterly, on the tight side, quarterly if not semi-annual basis, because you may be getting into a system during its drawdown period, and as soon as you get out, the drawdown period's over and it starts to turn. And my first preference is to find a good broker. And I'm not trying to advertise my brokerage here. I'm just telling you that as a trader. Find a good broker, somebody who's maybe a referral, has a good reputation, and who's actually taking their job and their fiduciary responsibility seriously enough to make sure that you stay out of harm's way. A good broker knows that if you do well, then they do well, because you'll continue to do your trading and all of that through them so they can get paid on your live trades through commissions. A poor broker just wants you to get in, wants you to trade at the lowest amount of margin possible, trade as much as possible, and then as soon as they have you in, they're moving on to the next. That's the industry standard, in my opinion, and that's what we created Stage 5 to change. But if I had $5,000 to invest into a trading system or into myself, unless I know for sure and trust my broker or somebody recommending a system or somebody who's created a system, I would more likely invest in myself. Trade something small, a micro product like the micro euro or micro Australian, and work out my psychological and technical issues there, and then invest in myself as a trader. Barring that, then systems, buyer beware. I would say I have not, being an insider in the industry, I have not seen very much out there that I'd be willing to invest in. And we're spending a significant amount of time and effort looking into those solutions because more and more people want to add trading systems as a side note to their actual discretionary trading. I know that doesn't help you, but that's as good as I can. That's as good as I can offer.
Anybody that really wants to know more on automated trading, there's a really good thread on BNT that I highly recommend. It's the title of the thread you can search for is "Taking a Trading System Live," and it's by Kevin Davey, and it's really excellent because he goes through the entire process, and there's the entire gamut of questions and answers. And it can really show you, even if you don't write your own code, it can show you exactly how things materialize and what to expect and how to measure it, So anyway, all right, we're a few minutes.
Education is key. Yeah, absolutely.
We're a few minutes past the 30 minutes, so we're going to stop here. If anybody did not get their questions answered, you can post them on the AMA thread on BMT, and FT will do its best to get those answered in the coming days. I'll post the recording there later today also. So thanks again, FT, as always, and we'll see you again in a couple weeks.
Thanks for having me on.
Sure. Bye, guys.
Sure.